All right, good Thursday morning, investors and traders around the world. This is your latest video from Phenom Group with me as your host, Seth Golden. And I know that this might, come at a disappointing time in the markets as we continue to see the selling pressure intensify with lower lows through this correction period. When will it end is what a lot of the bulls, what a lot of market participants are asking themselves at this point after such a strong first half of the calendar year. And the reality is nobody knows exactly or with any guarantees where the selling pressure will end, where the markets will find support. But there are good reference points for price historically, and we hope to outline them here in this week's video. So with that being said, yeah, this is what many people feel like right now. The market is crashing. It's a 2.5, almost 3-month long correction, and there's just a lot of disappointment on the side of the bulls, and the bears are starting to embolden themselves, and that's usually a telltale sign that we are long in the tooth, so to speak, or no pun intended, with regards to this corrective wave. Now, in our weekend macro market research reports, because I know a lot of people think, well, Seth, you're a perma bull, and all of a sudden you're turning bearish on the market. So I'd like to emphasize that I'm never bearish on the markets. Well, then you're a perma bull, Seth. I'm okay with that. You're essentially characterizing me in a manner which evidences that I'm basically right 75% of the time, right? Because the market is moving higher, delivering a positive annual return, 75, 76% of all calendar years since 1928. Like, I'm okay with that. Secondly, it's a mindset. There's only one way to invest well, and that's being positive, optimistic, and for lack of better phrasing and characterization, bullish. When prices go down, that's not a bad thing. That's not a reason to shift your focus or psychology when it comes to the markets, right? Our number one objective is to buy low, i.e. cheaper prices, and sell high. So when the market is giving you the opportunity to buy low, that's a good thing. I don't know why people automatically assume lower prices are a bad thing and something to be, in a state of despair about. All right, so with that being said, again, in our weekend macro market research report, this is what I wrote to our Phenom Group members. And if you don't receive our macro market research report, sign up today. It's only $14.99. You get our weekend research report. You get videos like this, exclusive videos that come out Thursday only to Phenom Group contributor members and premium members. Otherwise, you have to wait till the next week to get it, and the market may have passed you by. Key insights and information within our macro market research report have already been delivered. All right, so this is what I wrote this past weekend, given that the markets are still in this corrective wave. When the coming trading week commences and an even more favorable seasonal tailwind is in place, which actually starts today, the 26th of October, historically, we anticipate large cap leadership, but require the validation of any resumption of the uptrend to coincide with some degree of small cap participation. Now, for those of you who have been following the markets this week and experiencing the pain, you know that the Russell 2000 is retesting the lows from September, October of last year's bear market. So we don't have small caps validating large cap leadership, unfortunately. Such small cap participation has been sorely lacking over the last couple of months, proving to severely deteriorate the overall market breadth or internals of the market. A recovery doesn't come without risk, and we continue to view monetary policy uncertainty, escalating geopolitical tensions in the Middle East, and the dollar and treasury yields breakout as major headwinds for equity market momentum. And that's basically what we have here this week. We have the dollar holding steady. We have yields, which on Monday had a really nice outside reversal after the 10-year yield hit the 5% level, dropped all the way back to 4.85%. Unfortunately, you need follow through. Otherwise, that outside reversal day is meaningless. And unfortunately, we've had no follow through to the downside in Treasury yields. In fact, we're that much closer to 5% once again entering Thursday's trading session. If the overall technical backdrop should improve for stocks, interest rates and dollar stabilization will likely be key for continued upside in the fourth quarter. Again, we don't have that yet. Without such stabilization, bulls will have to manage cash and emotions wisely and simply push out your timelines for expected returns. There is no such thing as appropriately turning bearish on markets, as this is intrinsically an effort to time downturns in markets over simply buying dips and corrections that ultimately regenerate upside in the future. We remain constructive on markets, but also monitoring market internals for further deterioration or improvement in the coming weeks. And unfortunately, we do have additional deterioration in those market internals, in market breadth here this week. Now, in my opinion, no matter what we're going through right now in the markets, for whatever reason we're going through them, and you could list a host of reasons, as I already did, I think you should still buy now, profit later, or BNPL, right? We all remember that from the buy now, pay later stocks that went public and became, a focused topic over the last couple years. But my BNPL is buy now, profit later. And this came, right? This was actually discussed in another macro market research report by Phenom Group last July. Here, I'll show you that. This is from our July 3rd, 2022 12-month recovery roadmap. Now, within this roadmap, I offered to investors the probability that we're not out of the woods yet. The market was going to make lower lows. So what we wanted to do was prepare. We had all kinds of signals telling us we're probably going to see lower lows. But what I wanted to do is plan for that. You got to have a game plan in this business of active portfolio management. Our game plan, we set aside a certain amount of cash that if we got to such levels evidenced here in our roadmap, we would want to allocate if the market got to 36.66 and if the market got to 35.58 or even lower. Now, we got to both of those levels. We were enabled to allocate to index ETFs. And in this report, we specified we're talking about index ETFs. We don't want to be stock pickers during a bear market, because bear markets can extract a lot of pain on individual stocks, let alone the index itself. So we were able to actually allocate to these predetermined levels given our macro market outlook. And that's where I think you need to be today. You need to be game planning for potential levels to the downside, which I'm of the opinion we're going to see. So this was a fantastic exercise in game planning, but also if you had bought now, and I think I have this here, let's see where, well, I know I did, there it is, buy now, profit later. Now, in the moment, on July 3rd, it's like, Seth, you're looking for 3,600s, even 3,500s. It's a lot of pain. And that's the thing you have to be willing to do also in this business. You have to be willing to allocate some of that cash on the sidelines into the market, even if that means experiencing more pain. 36.66 down to 35.58, if not lower, is still a lot more pain. You're going to experience that much greater drawdowns because you have that much more leverage to the market. And you have to be willing to do that. And it reminds me of a story. Are you willing to experience that much pain for the rewards in the future? When I was a kid, I had a dog. Her name was Amber. is my first dog. And at the time she had an electric collar, one of those, electric collars that she could, wander the front yard, and unfortunately she could see other dogs being walked on the main street, but not, get out of the front yard, because once she hit the barrier on the electric fence, it would give her a little bit of a shock and she would not go further into the street. Now, this was a gated community, so it wasn't a big deal if she did, but we didn't want her to be a nuisance, from the other dogs. And one day I was outside, and, this was late in the day, and other, people were walking their dogs. And she just gets up, Amber, she gets up, and all of a sudden, as fast as I've ever seen her run before, she runs towards the edge of the property, leaps into the air, and you can tell that the collar has now shocked her as she's in midair, tumbles, onto the ground, what I understood at the time to be over the electric fence, gets up and starts, going down the street. And I was like, oh my gosh. So of course I ran after her. What I'm realizing, is that Amber was willing to accept the pain of the shock from the collar for the reward of sniffing another dog's butt. And that's essentially what you have to ask yourself today. No, not whether or not you want to sniff another dog's butt, but if you have a game plan that sets up where you can allocate additional capital, while the probability of experiencing more pain in your portfolio for the future reward later. For Amber, the future reward was, being able to engage these other dogs that are in the neighborhood. You have to ask yourself that question. Are you willing? Now, if the answer is no, more than likely you're not willing to do much with your portfolio because you're in a state of fear, and you're going to compound opportunity cost. That's no place to be in a portfolio. All right. So how did this all, what is going on in the market? We're asking ourselves. And I've listed in a number of reasons why we're in this corrective phase, but most importantly, we're in earnings season. We're seeing tremendous upside to earnings estimates. Right? Most companies are beating estimates rather handily. The banking sector has already reported, and for all the fear surrounding the banking sector, by and large, they've all beat. Whether the regional banks or the big money center banks like JP Morgan, Wells Fargo, Bank of America, they're all beating estimates. And we're not hearing any distress in the conference call commentary from CFOs and CEOs. Nonetheless, this is still taking place in the regional banking ETF. Now, what I think is happening here, based on where Treasury yields have traveled to, and the persistence of that 10-year yield to hit and achieve 5%, I think what's happening is they're selling banks no matter what they're reporting, because there's fears of another a mini banking crisis, if you will, akin to what we saw in March earlier this year. And that's probably a good bet. It wouldn't surprise me if we get some kind of headlines from certain regional banks over the coming weeks, given that the 10-year yield is just relentless to the upside. Sometimes the market can take on a life of its own and force breakages in the financial system. And I think that's what investors are afraid of. So no matter what the banks have reported, they're selling them. I mean, we're almost getting back to the May lows in the banking ETF, the regional banking ETF, ticker symbol KRE, down 9% over a 5-day period. This is just forced activity. I mean, JP Morgan is trading lower than where it went into earnings season, and it had a stellar report. You wonder why Jamie Dimon is speaking in the manner that he's been speaking over the last couple of weeks about the Fed, doing the wrong things. and the economy is still blah blah blah. He's pissed off, and I would be too. You're CEO doing the best you can absolutely do. Nobody wants your stock. What's going on? And he can't control it either. He can only control his business, which is doing quite well, and nobody wants his shares of JP Morgan. There's always a reason why these CFOs are engaging the financial media with these stories and characterizing their thoughts about the markets, the economy, the way they are. And I think this is one of those reasons. If anything, he's trying to expedite this breakage in the financial system so that we can get to the other side of it. And to my point about this is being forced on the markets, folks, look at the short positioning, the net long and short positioning in long bond futures, according to the CFT speculators report, i.e. hedge funds still short. With the 10-year long bond, 10-year treasury hitting 5% finally, they're pushing their bets on their short positions. They're forcing something to happen in the market. Now, usually this is a double-edged sword because it sets up the relief rally in treasuries as well as the shorts eventually do cover. But they're forcing something into or happening in the market. Now, a couple of weeks ago in a former video, we talked about the super oversold condition, which essentially is the reading, the S&P 500 10-day net advancers reading getting to negative 150. Historically, now this happened on October 3rd. Historically, you get a bounce, and we did. We bounced 4%. We bounced 4%. But the low from that date, taken with that reading, negative 150, 10-day net advancers for the S&P 500 is not the ultimate low in that corrective wave. You typically undercut the low within 20 days. And here we are, undercutting that low, which actually happened, I think, in 15 days, calendar days after the event, the initial low. So again, it's about expectations. We expected this to come to fruition. Sometimes you are at the low and there is no undercut here. But so far as the average undercut, it's 20 days later. This one was about 15. Now, we're losing like all manners of support, right? We're just breaking through key levels. We've broken through the 50-day moving average in the S&P and all the major indices. We've broken through the key 200-day moving average last week on a closing basis, and we just continue to drift lower, looking for additional levels of support. We just yesterday, Wednesday of this particular week, the S&P 500 dropped below the 38.2% Fibonacci retracement level, and it looks like it might be heading to the 50% Fibonacci retracement level of the bull market from the low of last year to the peak July 31st. I'd be, if I was a betting man, I'd be betting that we will get in and around that level. Realistically, I think we may even go lower than that. Seth, you're too bearish. I'm trying to be realistic because I've got a lot of cash on the sidelines. Lower prices are good as earnings are still rising. The economy's still in an expansion cycle. Credit spreads are not blowing out. You want to be buyers of this. You're getting value. This is a time to be optimistic and appreciate the opportunity that you're being presented. Our next chart here, this actually identifies the whole of the peak from 2022 to the bear market lows. We're setting up another Fibonacci retracement identifier of that whole period here, whereby historically, right, from the bear market, from the peak of the former bull market to the low, we had a bear market. We want to know what retracing 50% of the bear market move, we want to know where that level is. Well, that level The 50% retracement came at 41.90. Now, we're below that coming into Thursday, but historically, retracing 50% of a bear market move has tremendous forward return positivity rates. And here they are. When half the bear market was recovered, as we did this year, getting above 41.90 on a closing basis, stocks never moved back to new lows. Now, that was true before 2022. So we've actually now had one time in history where we've retraced 50% of the bear market and then made a lower low. It just happened in 2022. Now, above and beyond that, even if that happens, historically, 12 months later, the market has never been lower. Historically, 12 months after retracing 50% of a bear market low, the S&P 500 has never been lower a year later. And that looks to be true this go around as well. Now, what I'll say about that also is, remember, 41.90. That's this particular retracement, 50% retracement off of the bear market low. Historically, that means, and that happened on May 18th, by the way. There's May, and there's the first close right here. There's May, first close, 41.90 or better. So by May 18th of next year, no matter what happens between now and then, the market should be higher than 41.90. So if you're looking to allocate capital, again, this is still a good time. Even if we drop down, to that 50% retracement level, 40.73, I mean, historically, 100% of the time, 12 months later, you're above the 50% retracement level of the bear market move. All right, next up, how bad is it out there? Well, all sense of bullishness has disappeared from the market. If I look at the consumer sectors, consumer staples and consumer discretionary, their bullish percent index is well below 30. I mean, it's in bear market territory, levels we haven't seen since COVID, since the great financial crisis. I mean, here it even stayed last year. It stayed right around 20%, but anything below 20%, you're pricing in some kind of recession, some kind of bear market. Are those really the conditions? But even if that's what's going to happen going forward, that's what's getting priced in right now. The markets are a forward discounting mechanism. We're at 12.9. Actually, today, and I took a more updated reading for the consumer discretionary. I thought I had written it in. I guess I didn't. Yeah, well, I did for this particular measure. So this is consumer discretionary stocks above their 200 EMA, exponential moving average. This is the picture the screenshot I took on October 23rd. It was at 16.67% then. Again, historically below 20%. This is your buying opportunity. We got below 20% here. So far as consumer discretionary stocks above their 200 EMA, this is a buy zone for consumer discretionary stocks and likely the S&P 500 or NASDAQ. Coming into today, again, this was from the 23rd. Now it's at 12.96. Only roughly 13% of consumer discretionary stocks are trading above their long-term 200 exponential moving average. Moving forward, where might be the bottom? That's how we kicked off this video. Where might be the bottom of this particular correction? Historically, folks, the 200-week moving average proves major support. It was firstly resistance in 2010, coming out of the great financial crisis. We had the start of a new long bull market. It proved resistance, perfect resistance. And then in 2011, during the European debt crisis, it proved perfect support. In 2015, 2016's correction, it proved support. In 2018, and while we can't see this on in a weekly chart, on an intraday basis, in 2018, remember prior to this go around, the Fed was raising rates every single quarter. The Fed was tightening monetary policy in 2018, every single quarter. But in Q4, the market had enough, especially the bond market, where bond yields peaked and rolled over. The bond market had enough. The equity market, they were sending a message to the Fed, stop, you're done. We're going to force an issue, and they did. They forced a bear market, 20% peak to trough, at least intraday, in 2018's fourth quarter. And intraday, it touched the 200-week moving average. Again, proving substantial support. COVID was the only time it didn't, and we can understand why. Right? I mean, that was just chaos. Nobody had ever seen something like this in their life. Again, last year's bear market, folks, as rough as it was, key, awesome, magnificent support at the 200-week moving average. It wouldn't surprise me. And that's why I say more than likely we have more pain to the downside. 39.40 is the 200-week moving average. Again, as long as it's sloping up, you want to look at this as a potential buy zone. For me, it's a precise buy zone. I'm buying there. I've already got it allocated. These are my buy zones at 4109, which was where we had a breath thrust, the Zwig breath thrust this year on March 31st. That's my buy zone, which I'll explain in a moment why that's my buy zone. But 39.40, the 200 weekly moving average, is my other buy zone. And again, this coincides with what we did in July 3rd of last year, a 12-month recovery roadmap where we want to be outlining buy zones that we can buy now and get paid later. Buy now, profit later. These were our buy zones then. These are our buy zones now. And if it goes lower, we want to have at least another tranche of cash on the sidelines to take advantage of that as well. Why the Zwig breath thrust? Because again, historically, 6 months later, again, that happened on March 31st. 6 months later, there's never a negative return. The average return, which I don't care about, I just care about the market positivity rate. Market has never been lower. March 31st. So March, April, May, June, July, August. Were we higher than 4109 at the end of August? Yes, we were. So it's still perfect. 12 months after the Zwig breath thrust, again, never a negative return. So by March 31st, we should still be above the signal price on that date, which was 4109. I don't care how much pain is here in the near term. Maybe we do go down and test that 39.40 level. I want to be buying. Because historically, this is a key. Could it be the one time it doesn't work? Absolutely. I can't live in that. That's the bearish place to be. You know, if you're an investor and that just doesn't work for investor returns long term. All right. Last but not least, you know, again, this was from our weekend, just this past weekend's macro market research report. While breadth has continued to weaken, you can imagine that oversold conditions are likely forming and have potential to compound early this coming week, which they have. In fact, that would be my expectation by October 25th, which they have. And not to sound too pessimistic, at this point in the year in correction, I maintain a few specific points of data that still prove highly relevant and with respect to forward S&P 500 performance. The first data point relates to the existing Zwig breath thrust. Again, this was our expectation coming into this week. Unfortunately, it did come to fruition. But as long as you have the appropriate expectations, you don't need to panic. This was expected. Maybe not by you, but that's why you have the opportunity to receive our weekly research report in real time so you can stabilize your emotions in this particular corrective wave and have the appropriate expectations so that you can game plan and take advantage of this market weakness. With that being said, my name is Seth Golden. Thank you for tuning into this week's video, and have a great trading week, everybody.